Time to add Hungary to the list of debt-laden nations. According to a spokesperson for the country's prime minister, Hungary's economy is in a, quote, very grave situation. And as the region's sovereign debt crisis continues, it's weakening the euro even further, falling below 120 today. Dominic joining us now to break down these details for us. We're also joined by Kathy Lien, the director of currency research at GFT. She publishes technical and fundamental reports and previously worked in J.P. Morgan Chase's foreign exchange trading group. Thank you both. Dom, let's start with you. Non-farm payrolls number. What was the impact of that today?
I mean, the non-farm payrolls was a key for the markets here, but even before the markets opened here, we saw equity futures in the S&P dip just on the news from Hungary. Now, the Hungary situation was what the catalyst was for the euro fall and everything, but the comments were a bit shocking to a lot of traders out there. I mean, basically, a spokesperson for the prime minister comes out and says that the situation, like you said, is grave. Now, they also tossed out the idea of a clean slate.
Now, was it shocking because he said it, or was it shocking because the comments were so blunt?
Well, I mean, I talked to strategists who said it's both. The idea here that they're so blunt about the idea of wanting a clean slate. Now, the problem is we don't know what that means per se, but when bond traders, currency traders talk about a clean slate, you immediately think default, or you think bankruptcy, a way to, you know, start fresh, hit the reset button, if you will. And that's what dragged euro down. I mean, we're talking March 2006, the last time we saw euros here, and we've been talking about this correlation of euros for a while. Euro leads stocks, and we saw that today, so we don't know what's going to happen.
Kathy, what are we to make of that euro down below 120? What did you think when you heard this news today?
Well, in addition to what Dom mentioned, I think there's two other things going on. I mean, first of all, we had the German officials say that the only ones that are complaining about the euro are basically people who are not in Europe. And then also we had the French prime minister also say that there's only good news that comes with being the euro be seeing parity. So collectively indicates that we've got the G20 meeting coming up this weekend, that those officials probably won't do anything to support the euro. So I think that on top of the growing concerns in Hungary, as well as the widening spreads for Spanish and Italian bonds, are all kind of exacerbating the slide in the euro and indicating the problem in Europe is still here.
Kathy, let me ask you about Hungary, because and Dom too, because it's not on the scale of what's going on in Greece, but still a cause for concern, like this rolling snowball downhill now that you've been, you called it the pigs countries. We were talking about it before. But what's going on here?
Well, Kathy, I mean, correct me if I'm wrong here. The people I've been talking to have been saying that, Hungary, it's not part of the euro, if you think about it. But it's a country in Eastern Europe, also tied to the European debt contagion fear. The idea that we could be seeing what happened in Greece spread out to places like Hungary. Now, Hungary by no means is a big economy. It's only about, I think, less than half the size of Greece. So we're not talking a big country, but I mean, what's going on there?
Exactly. I mean, it's the same concerns that came out of Greece. I mean, Greece is not a very large portion of the eurozone on a GDP basis, but a lot of European banks in Germany and France lend to Greece. So the same problem is happening with Hungary because a lot of German and French banks lend to Hungary as well. But this actually increases the scrutiny on countries like Italy and Spain, and will kind of resurrect this concern, because throughout this last week, we didn't have too much talk about what's going on in Europe. The focus shifted to the situation in Asia and the situation is Israel, for example. And so right now, the focus is turning back to Europe, and that will be a very big topic next week with the ECB meeting and also with the EU.
Mark, you and I were talking about this idea here. I mean, we talked to traders today. How much further could this thing go? I'm talking to some traders who say it could go down to 110 soon enough here. So, I mean, is there any bottom in sight here for euro?
Well, we've been talking about a possible move to 120 for a very long time. And now that we're there, I think we'll probably see at least a slide to 118. That's kind of the level that we're looking for. And I think that at that point, you're probably going, I mean, obviously the euro is deeply oversold, and the positions in the IMM market indicate that the positions are still at record highs. So what that indicates is we probably will see another 2-cent slide, maybe even 3-cent slide, but I think it's not going to get parity like the French prime minister
Could I ask you too, given the news that we heard today about Hungary and given what we were talking about with the euro, how is that affecting the dollar? What are we seeing today with the greenback?
Well, I mean, at least my perspective here from what I've been hearing from traders now is that we can't emphasize enough this idea that the correlation between euros and what's happening with the stock markets.
Yes,
Obviously,
exactly.
a lot of people here worried about what's happening to the U.S. markets. Is that contagion spreading? shipping perhaps to the U.S. And again, like Kathy said, the only people complaining about this are the people who are not exporters in Europe. So the idea being, if we have a weakness in the dollar here, is that going to lead to, or strength in the dollar, is that going to lead to weakness overall in stocks and commodities? We don't know.
I think something's important to mention is that we had this G20 meeting, and even though the Europeans, based upon everything they've said, probably won't do anything to stop the euro's fall, the Chinese are very, very important. I mean, this is a G20 meeting. The Chinese are invited.
Let me ask you why, because you've said that twice now. Why won't they do anything?
Because you've got comments, explicit comments from government officials that are very close, that will influence the comments by the finance ministers and the central bankers, or at least the domestic central bankers, in telling them that they want the euro to weaken in order to provide monetary or to provide support for the economy at a time when a lot of these countries are doing really tight fiscal measures that's going to slow the economy. But what I want to mention is about China and how they're obviously concerned about their own euro holdings, whether or not they've said it or not, or admitted to their review of their euro holdings. So I think that even though the European policymakers are not necessarily doing anything to stem the euro slide, the Chinese could come up and say, look, if you don't join us in basically talking up the euro, that could actually encourage us to start, blatantly reconsidering our holdings.
And Dom, let me ask you quickly, because if we see this fall in the euro, talk to me how that's affecting the U.S.'s export base.
Well, the idea here is with a stronger euro or with a weaker euro, stronger dollar, weaker dollar, it benefits both sides of the Atlantic, okay? In this case here, a weaker euro makes exports more attractive because, a dollar used to buy you, it used to cost $1.50 to buy a euro. Now it costs $1.20 to buy a euro. That BMW from Germany is looking a lot cheaper now because you have to buy euros to buy that BMW. So here, in this case here, what we're looking at is it's helping those exporters, people like in France and Germany, who export a lot of goods. It's only helping them right now, Mark.
All right, Dominic Chu, Kathy Lien, talking currencies. Thank you both. Appreciate it.